On today's episode, we're going to take a look at two growth stocks. The first one is one that many people have heard of, and that's going to be PayPal. The second one we're going to take a look at is one that's a little less known, and that's going to be Celsius. So let's get started. Alright, so the first company we're going to take a look at is PayPal. We're going to take a nice in-depth analysis of both these companies, taking a look at historical growth, their balance sheets, their most recent earnings, how they collect money, and just their overall stock price performance. Like I said, PayPal is first, and for the day it ended 2% down, which is pretty. The market was pretty down for the day today, but it has been a great week overall. Let's take a look at PayPal's price performance for the past 6 months. And here I want to take a look at February 20th. And since February 20th, this is when the market really started to tank. PayPal has actually gone up 34%. The current market cap for PayPal is about $194 billion with today's price. So why has PayPal gone up so much throughout this whole pandemic type item? And we're going to see the amount of users that are using PayPal, and the overall engagement has increased throughout this time that we're going right now. And before we go any further, guys, don't forget to hit the subscribe button, the thumbs up, and the bell. It helps the small channel out so much, and I truly appreciate the support. If you guys ever want to get in contact with me, I'm very active on Twitter, and I do have a Discord channel, which is free to anybody that wants to join. And to be honest, both these stocks were requested by a member, so shout outs to Bill Brent for bringing both these companies to my attention, and just an idea for me to do an episode on. Finally, let me know in the comments below which episode you guys want me to do next. Do you guys want me to do a portfolio update, maybe my top 3 payment stocks, or maybe just a random growth stock, just to open up new ideas to other people? Alright, so now that we took a look at the price performance for PayPal, I wanted to take a look at what PayPal does and how it collects its revenue, right? Then we can see where the growth is coming from and how PayPal is transforming throughout this whole pandemic. So first, the most recent quarters, which were for March 31st of 2020, and I think they reported somewhere in May for this quarter, total revenue for this company was $4.6 billion. Out of that, that was a 12% growth compared to the same time last year. So we can see this is a growing company. To have a 12% year-to-year growth is not something that many companies are doing. PayPal collects its revenue from 2 sectors. The first one is transaction revenue, and out of that $4.6 billion, 4.2 comes out of there. So I want to say that's probably over 85% of total revenue comes from that section of transaction revenues. And transaction revenues is pretty much the fees that get applied to your payments whenever you use PayPal, and then there is a fee through that transaction. That's where transaction revenues occur. The second is other value added services, and this is $400 million out of that $4.6 billion. So less than 10%. So actually over 90% of total revenue comes from transaction revenues. Less than 10% comes from other value added services. And other value added services is PayPal does have a few type of systems. For example, where they have, if you're a business, you can use PayPal to help with your overall business, something similar to Square in its own sense. But again, you can see this is a very small portion of this company's revenue. But it's still good to know where that revenue is coming from. Transaction revenue is up 13% compared to the same time last year. Other value added services is up 2% compared to the same time last year. All right, so now let's take a look at PayPal's revenue growth for the past 3 years. So in 2019, this company's revenue grew 15%. In 2018, it actually grew 18%, and in 2017, it grew 20.7%. So we can see this company has shown strong double digits, right? This previous year was 15%, and this most recent quarter, what did we see? 12%. So it was pretty in line with what this company normally shows in revenue. What we do see, first of all, is there is a decline in revenue growth over the years. But remember, once a company gets big, it is a little bit harder for them to show that same type of growth. But still, a 15% is still pretty impressive in my mind. Next, let's take a look at this company's gross margins and profit margins. In the past 3 years, one thing I'm seeing is Profit margins have maintained pretty flat. So that to me tells me PayPal is already in a state where it's already a running machine, and there's not much growth in the form of profit margins, of gross margins gonna happen. In 2019, profit margins were 13.8. In 2018, it was 13.3, and in 2017 was 13.7. So it seems to fluctuate that profit margins around there. Another thing we can see is this is a profitable company, a company that makes money to investors. One thing I do not like is gross margins seem to be declining over the years. In 2019, gross margins were 44.9%. In 2018, it was 46.5%, and in 2017 was 48.9%. So we can see there has been a steady decline of gross margins, but they're still keeping it in those 40 percentage values, which are pretty high. Next, let's take a look at PayPal's most recent balance sheet that they reported this recent quarter. Let's just take a look at this company's debt. This company does not have any current debt, and it has about $8 billion of non-current debt. This company actually has about $8 billion of cash and cash equivalents and about $6 billion of current investment. So this company actually has enough cash and cash equivalents to pretty much pay off this company's total non-current debt, which is something that's not even needed, but right, it can pretty much pay off all its debt. And I think that's a really good thing. This shows that PayPal actually has a very strong balance sheet, because after it pays that total debt, it still has up close to $6 billion in cash left over. All right, next we wanted to take a quick look at this company's cash flow, and then we're going to take a look at some of the recent news that PayPal has gone throughout this whole pandemic. Right now, operating cash flow margins, we can see here, I put it in quarters. Throughout the past few years, it does show that operating cash flow margins are between the mid 20s to low 30s. Right now, it's actually in this most recent quarter was 32.57, and that seems to be one of the highest quarters that this company has seen in a very, very long time. On average, like I said, if we take a look at the annual, it does seem like it fluctuates between that 25 to 35 type operating cash flow margins. And what this means is out of whatever 100, for example, out of every $100 this company does of sales, it actually ends up keeping about $30 for cash flow from its operating business. And that to me is actually pretty good. If you're making this kind of money from your everyday activity, that to me tells me this is a good company. All right, so next I took a look at this company's most recent earnings presentation. And one thing that I actually found pretty interesting is how this company is using its capital allocation. So we can see in this chart, it breaks down its capital allocation in three methods. First, CapEx. So this is when they buy equipment or when they buy some form of plant that would be able to help them in the long term. It'll be more like a long-term asset. Then they have stock repurchase, which everybody should know what that is. And the second is acquisition and strategic investments. In 2018, a huge portion of it came from stock repurchase. Fast forward 2 years from now, 2020, most of the company's capital allocation is going to acquisitions and strategic investments, which I actually think is a pretty smart move. They're trying to grab other forms of business. The only thing is we need to make sure those other acquisitions make sense for the company. It's no point for PayPal to buy a company that, for example, I'm looking at my measuring tape, that sells measuring tape. How would that help PayPal at all? So we have to make sure that those other acquisitions actually make sense for PayPal. And we're going to take a look at a few of them in today's news. All right, but before then, let's just take a look at their most recent earnings. Like I mentioned, their most recent earnings show a revenue jump of 12%. They did see net new active accounts of 20.2 million new active accounts adding. This about 10 million of those came from an acquisition of Honey, and I actually don't know what Honey is. So let's just take a look at Honey PayPal to see what that was. Oh wow! So now Honey PayPal, Honey it's more like a coupon extension type thing where you get the extension, and whenever you're purchasing, it actually gives you coupon codes. So obviously this makes sense because then at the same time, once you're purchasing, with the coupon, you could be using your PayPal account to purchase that item. So it actually makes sense why PayPal would get this. Here's another crazy thing. They say that thanks to the pandemic, the e-commerce and digital payment trends in 3 months have gone where it would previously may have taken 3 to 5 years to achieve. So that's why you see these huge stock price jumps on companies like these in the e-commerce, companies in digital payments, because in just a matter of 3 months, these companies have grown to the amount of revenue they were expected to get in 3 to 5 years. So when you think of things like that, right, imagine only seeing a price increase of 35%, but now you're 3 to 5 years ahead in the future. I can understand why investors are still so willingly to be able to pay at these prices for PayPal. So next, let's take a look at some acquisitions or some form of investments that PayPal has done. The most recent came out in June 3rd, and both Facebook and PayPal invested in an Indonesian ride-hailing payment application. The Indonesian ride-hailing food delivery, shopping, and digital payment apps is in this latest round of fundings. As part of the commercial agreement, PayPal payments capabilities will be integrated into this platform, and it's called Gojek Services. Google and Tencent are already investors in Gojek. If you guys know anything about me, I'm actually pretty bullish on both those companies down there, Google and Tencent. The second type of acquisition or strategic investments was on Red Mula. Red Mula Payment Solutions has entered into a strategic allegiance with PayPal. This is going to address financial inequality amid the ongoing COVID-19 pandemic. And this is actually the most recent. This one came out in June 17th of 2020. So we can see right now, PayPal is really focusing on increasing its platform reach to different parts of the world. It's also seeing that ridiculous growth of 3 to 5 years within 3 months. So we can see I can understand why people are paying these prices for PayPal. Fine, let's take a quick look at this company's valuation. If we take a look at forward PE ratio, this company for December of 2021 has a forward PE ratio of 40.81. That to me, to be honest, I want to consider this between a growth stock and more of a value stock, right? Because it is not growing at those type of growth that we have seen other growth stocks grow, right? We've seen those, for example, the software companies growing at 30, 40, 50%. PayPal right now, it's growing at a little bit over 10%. So I wouldn't really consider it a true growth stock. And at the same time, this is also a company that is making money. Margins seem to have been stabled off. They don't really seem to be moving much. So it's more of a place where I don't foresee much margin growth in any direction in the near future. So I'm gonna use both forward PE ratio and both forward price to sales ratio to see any quick evaluation for this company. For December 2021, like I said, a forward PE ratio of 40.81. That might be a little bit high for many people, but understand what we're paying for, right? We're paying for a company that is growing at about 10 to 15%, that has a very, very strong balance sheet, and is in a market that can continue to thrive throughout this whole thing. If we look at forward price to sales ratio is 8.35. 8.35 to me is actually not bad with a company that has margins. Let's take a quick look of margins. A profit margins of about 13.8. It has gross margins of 44.9. It has revenue growth about 15%. It has a strong balance sheet, and it has strong operating cash flow margins. So to me, I already have position in PayPal, but I'm still debating right now if I want to enter more into it. Even though right now, if I did not, for example, this is not advice, these are just my thoughts. If I did not have a position in PayPal and I actually wanted to enter PayPal would definitely be a contender. But if I was worried about the valuation being too high, I personally would still enter in a smaller position just to ride the wave. Right, I actually just did an episode on Spotify just 3 days ago. Spotify, again, a company I've been in since $150, but I just did a recent video of it when it was at $200, and I said the same thing. I was like, I'm in Spotify right now, but if I didn't have a position in Spotify, I would not want to. I believe in Spotify. I believe in its market cap. I believe in the growth. So even if I thought the valuation was still a little too high, I would still enter, because I would rather ride the wave even with a small position. And like, let's think of it. If I would have entered Spotify with a smaller position, I still get the gains when it goes up. And if it goes down, I'm already bullish in the company. So it's just going to give me more alerts to enter more in the position. So that's similar how I do things. Especially if I am worried about the valuation, I would normally just go in with the smaller entry position. But I think every investor is different, and some investors might think this is a bad investment. Some investors might think this is a good investment. And to each their own, there's so many ways to make money in this market. The second company we're going to take a look at is one that probably not many have heard of. I honestly did not hear about it until one of our members in the Discord channel actually brought it up. Bill Bren, am I saying it right? Let's check out Bill Bren. Yep. Bill Brent mentioned it in our Discord channel. So shout out to you, Bill. I mean, you're gonna become famous after this. But yeah, he recommended this to take a look at this, and this is Celsius Holdings. Celsius Holding is a beverage company that sells fitness type products, fitness type drinks. First, let's take a look at the market cap of this company. Market cap is $705 million. It does not even have a $1 billion market cap at the moment. Next, let's take a look at the price performance in the past 6 months. Let's take a look since February 20th. This company's stock has gone up about 65%. So again, this has taken a big jump, and we're going to see why this company has actually seen this kind of jump. So first, let's take a look at Celsius. Like I mentioned, they are a maker of leading global fitness drinks. Celsius is the thing, and they're in their most recent earnings, which were in February. They reported May 12th of 2020, quarter one. There were some things I want to highlight about it. First, this is a company it's making not a lot of revenue. It's only making $28.2 million of revenue a quarter, and that revenue is actually up 95% compared to same time last year. So this is a strong growth company. They are, like I said, they're really small, so they are still getting situated into different retail stores. They just launched national product availability within Walmart at more than 1,500 stores. How many stores does Walmart have? Walmart store count. Let's just see right now. So Walmart has about 4,800 stores. So this is the type of growth that's possible. If right now they're only available in about 1,500 stores, if Walmart likes them, imagine if they start going into 4,800 stores of them, then that would be pretty bullish for this company. The next thing, they also just expanded nationwide product assortment to 5 flavors at more than 1,500 Target locations. And now let's look at Target store count. So Target has about 1,800 stores. So they're probably pretty much at almost every Target store right now. But again, just to know that a big retailer like them has a product like this and they're starting to expand, I can see why this is a strong growth. And they are, in the most recent earnings, they have continued to do stuff to increase their overall brand awareness. For example, they launched workout programs via Instagram, which I think was actually pretty smart for them during this whole COVID-19. They announced partnerships with certain influencers, and their direct store delivery distributions in North America grew to over 100 partners compared to 50 when this strategy was highlighted less than probably about a year ago. So that's actually pretty impressive, the amount of growth this company is seeing. Now I want to take a look at the revenue breakdown of how this company makes money. So like I said, it's pretty much through sale of their beverages. They might also have some form of licensing fees. But let's take a look at revenue breakdown. In the first 3 months of 2020, this company made about $28 million. Again, a very, very small company. But remember, I said 95% increase compared to the same time last year. More than 100%, even close to 75% of this company's total revenue comes from North America. North America makes about 20 million out of that 28 million, and that actually still grew 70% compared to the same time last year. The other biggest is Europe. Europe makes up a huge portion of 8.5 million of that 28 million, and that saw an 183% growth compared to the same time last year. Asia and others make up a small portion, about 300,000, so not even in the millions. That's how small it is. and that's up about 400% compared to the same time last year. So there is still so much market growth this company can get in if things progress for the company. All right, so now let's take a look at revenue growth for this company. And Celsius, if you guys are listening to the podcast, ticker for this is CELH, but it's spelled just like it's pronounced, Celsius Holdings. And like I said, let's take a look at revenue growth for this company. In 2019, it grew 42%. In 2018, it grew 45%. In 2017, it grew 58%. This most recent quarter saw a revenue growth of 90%. So it's way above its average. All right, next, let's take a look at this company's margins. So the first thing we can see, 2019's gross margins were 41.7%. Like I said, it doesn't seem like this company's margins increased or decreased by much throughout the years. So it's fair to say that gross margins for the next quarters, for the next years, is going to be around the same level. Now let's take a look at this company's profit margins. This company's profit margins for the most recent quarter, for the most recent year, was 13.3%. This was actually the first year this company was able to be profitable. On average, this company was losing about 21.7%. Let's actually take a look at the most recent quarter and see its profit margins. Profit margins this most recent year, for this most recent quarter, was 1.9%. I do believe the reason this company was profitable margins in 2019 was because of either some one-time payment, some one-time savement that this company had that year. But I do think on average, this company is still averaging either close to break even or negative type of profit margins. So like I said, I don't think this was more of a black swan event. Next, let's take a look at this company's balance sheet. In the most recent quarter, so let's pull up the most recent quarter, this company has about $9 million in current debt. That's it, $9 million. This company has about $19 million in cash. So it has plenty of cash to pretty much pay off its total current debt. And that to me tells me this company's balance sheet is pretty okay. Even though to me, I seeing this amount of cash level is pretty low. In theory, if we're taking a look at ratio types, this is a very strong balance sheet. I would have totally loved it if this company had over 100 million in cash or cash equivalents. Next, the final thing I want to take a look at when we take a look at historical values is this company's operating cash flow margins. This is cash flow that it gets from its everyday activities. And normally you want this to be positive, right? Because this company should be making money from its everyday activities. If not, what's the point of the company? In the past 4 quarters, even counting the most recent quarter that was on March, 3 of those quarters were positive. And those were pretty much the ones that were positive throughout the past 6 years. On average, most of this time, the company does have negative operating cash flow margins. In the most recent quarter, which was of March, this company's margins were negative 13.5. So if there was one bad thing about this company, this would be the one. This is the bad thing that's really telling me what's wrong with this company is this negative profit margins and these negative operating cash flow margins. Obviously, what is expected to happen is as this company's revenue continues to grow, when that revenue grows, margins will grow, and so will the operating cash flow margins. So that's understandable, but how long for that to take place? So now let's take a look at this company's valuation, this company's forward PE ratio, and this is for non-GAAP earnings per share. For December of 2021 is 70. It has a forward PE ratio of 70. So analysts actually expect this company to actually become profitable this year and next year. So that's actually a good thing. But a 70.07 forward PE ratio is pretty high if you're looking at that. But remember, this is a company growing revenue by over 50% annually. So you have to keep in mind of that. Forward price to sales ratio for this is 4.83. Again, remember what you're buying. You're buying a company with very strong revenue growth. You're buying a company with negative profit margins, but a decent gross margins. You're buying a company with a very strong balance sheet in terms of ratio, maybe not in terms of monetary value. And you're seeing a company that's expanding itself into different markets, and all those markets we're seeing very strong growth. So to me, a 4.83, again, this is actually a company that I might personally get into on Monday. If I would have done this video today earlier, I'm pretty sure I would have entered the market. But if there is no big gap up from now, the current price is at $10 with a valuation of $705 million. If I don't see a big gap up on Monday, this is a company I would enter with like a 2% of my portfolio. Again, these are just my thoughts, not advice at all. I am nowhere near a professional, but it is a company I'm liking, and it's a company I wouldn't mind holding to see that continued growth, right? This is also, like I said, a very, very small company, and throughout the Discord channel, there are many people speculating that this is actually a company that can actually be bought out by bigger brands out there. And that's actually very true, right? With the $705 million valuation, if the product shows that it's actually doing really well, I can actually see another big company buying out this company. So I hope you guys enjoyed today's episode. Like always, make sure to subscribe, hit the thumbs up and the bell. It helps the small channel out so much, and I truly, truly appreciate the support. Take care, guys, and see you next time.